Okay, let's get started. Hello, everyone. Thank you for joining us for private equity investment in orthopedics, key transaction considerations. A few key housekeeping notes to get started. All attendees are in listen-only mode. We will be using the Q&A function today to gather questions for our speaker. We will not be using the raise hand function. Please submit questions through the Q&A and interact with other attendees by posting comments in the chat. When using chat, just be sure to select all panelists and attendees from the drop-down above the message box before submitting your chat so everyone can see it. This webinar is being recorded. Please know we will be sending all registrants the webinar recording and PowerPoint slides via email in the next couple of days. Our speakers for today are Gardner Armsby and Rick Zoll with King & Spalding, and Jake Vesley and Scott Davis with Provident Healthcare Partners. Now I'll turn it over to our speakers to get us started. Let me introduce our moderator, Scott Davis.
Thanks, Young. Appreciate it. And welcome to our attendees for today's discussion focused on private equity investment in the orthopedic sector. As noted, my name is Scott Davis, and I'm a director at Provident Healthcare Partners. Joining me from my firm today is Jake Vesley, who's an associate with our firm. And on from King & Spalding, the law firm, is Rick Zoll, who's a partner and chair of the healthcare transactional and regulatory practice, and Gardner Armsby, who's a senior associate within their healthcare practice. Briefly on the introduction for Provident, we are an investment bank that's been around for over 20 years, really providing the same services since our inception, which is to act as sell-side representation to the owners and operators of healthcare services businesses, primarily focused the last kind of 6 to 8 years in the physician practice subspecialized category. Within that, we spend a good amount of our time in the broader musculoskeletal space with a particular focus within orthopedics. Rick, would you mind introducing your firm?
Sure, be happy to, Scott. And thank you, everyone, for attending. I'm Rick Zoll. I'm a partner at King & Spalding. We are a international law firm with about 1,200 lawyers across the world, about half in the United States. We have a healthcare practice that's comprised of about 100 lawyers across the United States, and we focus on representing providers and other actors in the healthcare industry. A lot of our work of late has focused on private equity activity and physician practice consolidation, representing both physician practices and private equity firms. And among the various specialties that we've worked in is orthopedics, which we're going to talk a lot about today. Thank you.
Thanks, Rick. And with that, I think we can jump right into the content. I'll just start with a quick primer on kind of how the market stands today from a private equity investment perspective, kind of how we've seen things play out from a timeline perspective, and what we expect to happen in the not too distant future. So what we've typically seen, and again, we're a group that's focused on physician practice subspecialties for a number of years. When there's going to be a real run of investment in a given subspecialty, we typically see, call it a trickling in of initial platform investments over a 12 to about 24-month time frame, followed by, again, if there's going to be a lot of investment in the industry, a real run on the space where platforms will be developed on a much more rapid pace, as well as add-on activity kicking off alongside that. So I think a couple of good case studies on that would be the areas of dermatology and ophthalmology, both of which really followed the exact playbook that I outlined, where call it a handful of initial transactions happen within that initial 12, 18, 24-month time frame, followed by a real run on the space, with both of those subsectors really topping out around 25, 30 plus platforms respectively. Those have since matured to the point where we're seeing consolidation of those groups as well, and I'd say less active on the new platform front. As we think about that from an orthopedic perspective, we saw initial transactions kick off at a similar time frame actually to those other areas, call it the 2017 timeframe. Groups like Southeastern Spine Institute being recapitalized by Candescent Partners, Orthopedic Care Partners being recapped by Varsity Healthcare, and Hopco being recapitalized by Frazier Healthcare Partners. Following that, there was some activity in subsequent years, 18, 19, 20, did see, I think, 2 or 3 total transactions, but not quite the same playbook we would have expected at that point. It wasn't until the most recent 12 to even 14 months where we really have seen things ramp up. So, our research and industry tracking shows that 7 new platforms have actually been established since the start of 2021. Groups like American Orthopedic Partners taking on investment from Stone Point Capital, Novum Orthopedics being established by A&M Capital at the end of last year, and Resurgence Orthopedics recently being recapitalized by Welsh, Carson, Anderson, and Stowe. And so it's a little unique in that it's taken some time for what appears to be the real run on the orthopedic space to kick off. But nonetheless, our outlook is that will persist, this kind of rapid acceleration of platform creation coupled with add-on activity to go alongside those. Another aspect that's worth noting from a consolidation standpoint is the fact that we've really only had one group reach what we refer to as a second bite scenario or an exit of a private equity group. And that was with Hopco recapitalizing in 2019 and taking on investment from Audax Group and Linden Capital Partners. Given some of the longevity of the early day platforms, we'd expect for that to accelerate as well. But again, with only several groups having done recapitalizations a handful of years ago, we wouldn't expect to see kind of a rapid acceleration of exit activity for some years to come here. So the question becomes, why was the acceleration of the consolidation slower within this space? And I think there's a number of different ways to look at it and probably some different opinions. From our perspective, we view the orthopedic space as a unique one. Just looking at the makeup of the groups, very much, and there's a large group that are certainly inpatient focused, but also historically a large camp of providers that have preferred and always worked in an outpatient setting. And that's gone on for a couple of decades anyways. And the complexity of these groups has really evolved over time. And I think they've evolved that way for good reason and to the benefit of the people involved in those practices. But it does become an interesting thing to unravel from an M&A perspective. So things like hospital relationships, the involvement of third-party ASC operators, relatively complex compensation structures that have evolved as ancillary services get brought in, new partners join practices, things of that nature. We would, on average, put those as relatively more complex than some other subspecialties that we work in. So I think there's something to that where overall investment has a little bit slower to kick off, just given the complexities that it takes to really make these deals happen. And then more recently, I think we've seen the recapitalization and partnership of some real brand names in the industry, which I think has helped push things along. Groups like the Andrews and Stedman clinics that are real brand names nationally, even internationally as well, that I think has really opened the eyes for some provider groups to really consider the fact that their colleagues and some of the who's who of their industry are considering this option. There's really got to be something to it, I think, and so the openness has expanded over time. So with that, I'll take a pause here and I'll bring in the K&S team. Interested to get those folks' thoughts on the drivers behind the heightened interest within the MSK market as a whole.
Sure, I'll jump in. Thanks, Scott. This is Rick Zoll. I think that one of the things we've seen is just the continued push from inpatient to outpatient, and I think a lot of hospitals deciding that they really want to partner with, but not necessarily control every aspect of the business. And so as a potential partner, I think the hospital sector has been less active generally. Obviously, there have been a lot of things to worry about on the inpatient side and with reimbursement generally. I also think that from the standpoint of reimbursement, the trends in orthopedics have been stronger in terms of maintenance of rates than they are in some other sectors, which has, I think, been another impetus for the renewed activity. And lastly, I'd say the ancillary service mix of orthopedics, the fact that there are a lot of radiology, imaging, lab, and ambulatory surgery opportunities for orthopedic practices make them attractive to private equity. And the valuations, as we'll talk on the private equity side, have remained very high and attractive to physician consolidation generally.
Thanks, Rick. And you touch on some different concepts there around just the breadth of the industry. I'm going to bring in my colleague Jake to speak to that. Jake, if you wouldn't mind speaking to us about really the different service offerings that we put under this broader umbrella of the MSK market, I think that would be helpful for the audience.
Yeah, of course, and thanks, Scott. In addition to the interest we're seeing in the orthopedic space, we're really starting to see more and more investor interest in the adjacent musculoskeletal verticals as well. So, things like neurosurgery, interventional pain management, PM&R, and others. Especially as healthcare transitions more towards bundled payments or a value-based care environment, groups are really looking to build out comprehensive service offerings to capture that entire continuum of MSK care. So just backing up a bit as to why we're seeing this trend. So across the United States, the national health system is really struggling with rising costs and uneven quality, despite the best efforts of these well-trained physicians. Take lower back pain, for example, which is one of the most common and expensive causes of disability in the United States. In the most common approach to treating lower back pain today, patients receive portions of their care from a variety of different clinicians and usually at several different locations, all of which are operating independently rather than an integrated team. So a patient may begin their care at an orthopedic doctor, while others may start at a primary care doctor, a neurologist, or any other type of doctor, and the path for the care for that patient is extremely unpredictable. That patient may be referred to a different physician or to a physical therapist or undergo various forms of imaging services. Each encounter is different and no one's really coordinating or measuring the patient outcomes. And this is resulting in inefficiencies, poor clinical care, and higher healthcare expenditures. So I think that payers and investors alike are really starting to realize the inefficiencies of this. And as a result, we're starting to see groups really try to integrate services to provide a more cohesive MSK care offering with better patient outcomes at a lower cost. And a few examples of this are Hopco, which is backed by Onyx and Linden. They offer orthopedics, neurology, pain management, PM&R, PT, and a variety of other services. And another example is Health Plus Management, which is backed by InvestCorp, who offers PM&R, PT, and orthopedics while looking to expand into other adjacent specialties. Another example is Spire Orthopedic Partners, who's backed by Kohlberg. They started to combine orthopedics and neurosurgical offerings. And I think over the next few years, we'll really start to see this trend continue, and we'll see more and more groups utilizing M&A in an attempt to combine these service offerings across the MSK continuum, really to provide the best value-based and patient-centric care possible.
Appreciate it, Jake. And then sticking with you, I know that one of the things that groups wrestle with as they consider options for next steps is, what direction to go. There's a few different options as it relates to types of partners or simply staying independent that groups weigh. Could you speak to the options that are on the table and maybe some of the upside and downside for each?
Yeah, of course. And like you mentioned, the first option is for groups to just stay independent. That said, I think that independent practices are facing increasing amounts of threats each year. Groups need more size and scale to meet these regulatory threats or threats to revenue that are inevitably going to come down the line with value-based care and a host of other challenges. And as a result, really we're seeing groups explore two main options, either via a hospital or health system acquisition or merger, or going the private equity route. So the first one that I'll touch on is partnering with a hospital or a health system. Typically, this is the least attractive option for our clients as, these hospitals or these health systems, they offer less autonomy. They usually offer lower valuations than our private equity peers. And they also offer limited ability to participate in the upside. So doctors are usually a straight salary or they're comped on an RVU basis with no ability to participate in the ancillary income or the share in the profitability of the larger organization. And because of this, many groups today are exploring private equity as an alternative to remain independent. Critically, the difference between private equity-backed enterprises and hospital physicians is the fact that the folks who are partnered with private equity, they remain equity holders, which is really the key to remaining independent in these transactions. So within private equity, there are a few options. The first is becoming the platform. The second would be being a regional platform to an existing PE platform. And the third is partnering with a larger group that may already be in your existing geography. So when we start to have these discussions initially with practices, most want to be the platform, so to speak, but there's really a limited number of groups who can truly qualify as a platform in today's market. First, there have to be certain levels of revenue and profitability, as private equity firms have minimum equity check requirements for new platforms. Groups also have to have made significant investment into their infrastructure so they can support future growth. And while private equity will certainly make investments into the infrastructure, there really needs to be a strong foundation in place to support the rapid growth of the business. But for the groups that do qualify as a platform, there are a lot of pros and there's also some cons as well. So when you're the initial platform, you're really helping determine the direction of the platform. You have a meaningful say in almost everything. And with that comes a lot of expense and a lot of time and having to think through, all the different issues and working with your new private equity partner to determine what that game plan is moving forward. It also offers the highest potential upside as well. Typically, you'll get the best economic and governance terms. You'll have the most control over the board seats compared to, say, the 10th or 11th add-on, who's going to have, much more limited say in the overall governance of the platform. But there are some risks. And although I don't think it's particularly high, especially in our processes where these groups are partnering with sophisticated private equity firms that have had success in other specialties and are very knowledgeable, we typically see these platforms go on to be very successful, but it is higher risk to be the initial platform rather than, joining a group that's been established for 4 or 5 years. So the other option is, joining in an established private equity platform as their regional platform. So this is a great option for those that don't want to join someone in their backyard, but may not necessarily have the size or scale to be a standalone platform of their own. So in a regional platform, practices are given certain autonomies within their particular region, and oftentimes they form a regional MSO that sits underneath that national MSO, where they can have, very meaningful equity appreciation attributed to the growth of, the region that they're responsible for. And, I'd say the last option is just a standard partnership with a PE-backed organization or an add-on. And this is a great option for smaller practices or those that simply think they would be more successful by partnering and gathering forces with like-minded people rather than creating that platform from scratch. And the pros and cons of being an add-on are essentially the opposite of what we just discussed. There's lower risk on the rollover equity portion, and oftentimes you can see meaningful appreciation in a shorter period of time. There's also less time and money involved as you're essentially just getting plugged into an established organization.
Thanks, Jake. And then sticking with the concept of the private equity option, given that's what we're here to talk about today, typical question is just for groups who haven't been through that process just yet, how are those deals structured and really what goes into them? In particular of note is the concept of using debt to fund a portion of those transactions can at times seem daunting to someone who's, again, not been through the process. So I'd like to spend a little bit of time there and maybe bring in the K&S team to kick us off on that kind of debt versus equity topic out of the gate here.
Sure, Scott, I'll jump in. I'd say in almost every one of the PE transactions we've done with physician groups, the PE firm is looking to both invest equity capital that they have raised, but also to take advantage of debt financing to extend the impact of the capital that's available to the new practice and its MSO. And there are lots of lenders, both traditional but also alternative lenders, many of which are either hedge funds or affiliates of private equity firms that will lend into this market. So typically, and as we'll discuss, what's involved certainly in the creation of the platform is an establishment of a management entity, and that entity contracts with the physician group. And so the management entity is the one into which the private equity firm will contribute its capital, its equity capital, and then based on the projected pro forma and how much cash will be generated by the platform going forward, they will turn to the debt markets. Usually the leverage ratios can be as high as 4 to 5 times for many transactions. You usually don't see a lot more than that. Again, From the physician group perspective, the concern is you don't want too much leverage with the requirement to pay debt service to that lender or risk of default. So often in the negotiation with the private equity firm, a key element of the deal is figuring out how much are they going to lever that investment, and being sure that it's affordable by the new management company with the cash flow that's there. But obviously it does help everyone to have less expensive financing from a lender than the kind of returns that the equity capital providers require.
Thanks, Rick. And now as we turn our attention to, what does this mean for the deal itself and the proceeds to an individual shareholder, we'll spend some time on that concept. So the proceeds are going to come in two forms, either cash at close or rollover equity, reinvestment into the business. So starting first on the cash side, we usually see that come in a majority recap situation, which is most typical in a physician practice deal. The magnitude of that portion of the pie is usually somewhere from about 60 to 80% of the overall enterprise value. This is generally created, and we'll spend some time on how this happens, but the cash flow for the transactions created by a compensation reduction to create the profitability. That's what's marketed to investors and therefore creates the enterprise value. So really, if from a shareholder perspective, it's a matter of I'm reducing my compensation for the benefit of cash today. So how do those two things compare? The most notable way is the fact that you get a tax arbitrage on taking it today. Reason being, you're paid for your equity position. So you'll be taxed on a long-term capital gains rate as opposed to ordinary income, which would be how your daily, weekly, annual compensation from practicing medicine would be treated. And so, historically speaking, we'll see where the ultimate revised long-term capital gains rate ends up if it does move. But historically speaking, it's been about half as much taxation, taking these cash proceeds from a transaction as opposed to kind of earning W-2 compensation. Another factor, of course, is the fact that there's a multiple applied to it. So these businesses are marketed on a certain level of profitability. The investor community will apply an EBITDA multiple to it to get you to your enterprise value. In other words, you're taking several years worth of income, whether that be 8, 9, 10 times, all at close today, coupled with the preferential tax treatment. So a lot of advantages there from a financial perspective. Also, a lot of other considerations to go into whether you do a deal, but from a finance perspective, a lot of advantages there. As for the other component of the proceeds at close, the rollover investment, this is something that just about every, certainly practice, should expect to have to participate in a transaction. It could differ from shareholder to shareholder, depending on where you are in your career. But thinking about it from the practice perspective, it should be expected that the requirement from the investment community would be anywhere from, call it, a 20 to 40% is the typical range we see of reinvestment of the enterprise value back into the business. Reason being, in addition to the fact that there's a lot of cash proceeds taken at close, and that could be disincentivizing to shareholders to continue to perform post-close, the investors need to have comfort that you've got some skin in the game. And so that's really what that's supposed to represent. That 20 to 40% ownership position can really be as meaningful, and maybe even some instances more meaningful, the initial liquidity event was to that group. And so it's important that that be in place, and the exact amount of it can differ deal to deal. That could be pushed forward by the preferences of either the buyer or the seller. It could be dictated by some extent the size of the shareholder group, the age of the shareholder group, kind of where they are in their careers, the type of investor that's come along. Is it a private equity investor viewing the business as a platform versus a strategic investor viewing this as an add-on opportunity? All these things can factor in. But again, I think a good guidepost is that 20 to 40% range, with the more common being somewhere in the middle there, call it 30+%. And that's going to be really important, again, at the end of the investment life cycle, whether that's 3, 4, 5 years down the road. This concept of a second bite that we talked about off the top of the webinar, that's where you get to realize the value on that ownership position. Not only have you deferred the taxation on that from the original deal, you now get the similar cap gains treatment at this subsequent liquidity event that, again, if the partnership's gone well, the value of that equity has grown to the extent where it could be, again, as meaningful as the initial event, yet you own a fraction of the original position that you had in the business. So that's where it becomes really exciting. And for the folks that have more longevity in their careers, that are maybe early to mid-career, the option is not just necessarily a second bite. There could be a third, a fourth, as the private equity model plays out and this investment goes to larger and larger private equity funds over time. Another thing to note is in the rollover, it could come in a couple of different forms. If other subspecialties of consolidation are any indication, what we'd expect to see develop more and more in the orthopedic sector is the opportunity or the demand that the rollover equity be taken either at the what we refer to as the top co level, kind of the parent entity, and or at a local level, kind of continued ownership and your local performance. And that could be, you know, a move put in place by the investor community to, you know, further entice and push the local physicians to be as productive post-close as they were pre-close. And then it's not uncommon for us to see when there's locally retained ownership, the potential for distributions to be put out as well. Again, we've yet to see that play out in a really meaningful way so far in orthopedics, but we have seen it play out in other subspecialties and assume that that would follow here. And as we think about now kind of the regulatory environment and the legal structuring for these transactions, I'll bring the K&S team back in to speak to that topic.
Great, Scott. Thanks. I'll start off, and Gardner will jump in. You know, there really is a doctrine here that people may have heard of called the corporate practice of medicine that requires special structuring of these transactions. And essentially, that doctrine, which is applicable in most states, there are few exceptions, but in most jurisdictions, it prevents a non-licensed professional from owning a practice of medicine. In this case, it also applies to dental practices and other medical specialties. And so as a result, the way this has evolved over time is that the private equity firm will set up a management company, and the rollover equity that Scott was just talking about is available in that management company, while the physicians continue to own, in some cases, or certainly be employed by an affiliated practice, often the practice that was set up and has been operated all these years. And then there's a management agreement between the practice and this MSO, and the management services fee, which must also be structured to comply with state law, is effectively designed to move the profits from the business after physician compensation into the management company. And that's now become a pretty tried and true hybrid where the physicians maintain the clinical enterprise with their PC, and then the non-clinical assets are purchased by the MSO, and the MSO runs all business aspects. One variation on that theme that we'll talk about is something called the captive PC, where the physicians remain employees of the practice, but the private equity firm insists that there be a physician who is the sole shareholder of the practice, and usually is someone affiliated with the private equity firm. So that's the construct, and I'll turn it over maybe to Gardner to provide some examples of the variations on that theme, because this is an important part when you're a selling practice in negotiating just how this works, because it really will speak to what kind of role you continue to have on the clinical side and what kind of role you may have on the business side.
Thanks, Rick. Yeah, as Rick was saying, there are a lot of variations on this MSO model. I think what we see more often when PE firms are coming in and investing is they treat it more like it's a true subsidiary type of relationship. So it's the captive model that Rick was referring to, where you will have one sole physician who is affiliated with the PE fund, who serves as the owner of the practice. Sometimes if it's an investment in an existing practice, they'll just pick one physician among the members. Other times they will already have a relationship with a physician who they can bring in, and they'll serve as the basically the figurehead owner. And by having that affiliation, they can effectively control the practice. The practice is not going to be able to terminate the management services agreement if the practice is controlled by this friendly physician who is affiliated with the PE fund. So that's from the perspective of the PE fund, they're wanting to have just as much control as possible over their ownership, over their investment. Another way that they exert control is through ownership of the non-clinical assets, which generally include pretty much everything that's tangible, with the exception of some equipment that you might need a license for. So the building, the chairs, all the computers, those will generally belong to the MSO, so that the practice, if they walk away, they're not going to have, they'll have the doctors with them, but they won't have everything needed to support the doctors. And the MSO will also generally employ all of the non-clinical staff. So all of your billing people, the front office people, those will generally be employees of the management company. The key agreements that you'll be negotiating when these MSO models are set up there's the management agreement, and then there's a stock transfer restriction agreement. In the management agreement, the key term for the PE investor is they want a long-term and very, very limited termination rights. So you'll see like a 10, 20, 30-year term with automatic renewals, and generally very, very limited rights for the practice to terminate without cause. From the perspective of the practice, I think the biggest issue that they want to negotiate is the cash waterfall. So the management agreement is the mechanism by which all the money is swept from the practice into the MSO so that the PE fund can get paid off and pay its investors. But the management fund, or the management fee, which represents the profits, that they want to make sure, if you're the practice, that is only paid after all of the physician comp that's been promised has been covered. So you'll see a waterfall provision in the management agreement that will specify that, first it goes to compensation, then to expenses at the practice level, then generally to the management company's expenses, and then what's left finally gets swept over as the management fee. In the stock transfer restriction agreement, which is also sometimes called a succession agreement, generally, if it's a true subsidiary relationship, there will just be a right of the management company to replace the friendly owner pretty much at will. Now, that's not allowed in every state, so sometimes there needs to be some kind of workaround where there's more of an objective standard. And sometimes if it's not a true subsidiary relationship, if the existing, if the legacy owners are maintaining ownership of the practice entity, then there can be more rights in favor of those equity holders where they can only be removed for cause. It's a negotiated point, but again, most often when it's a PE investment, what you're going to see is the sort of without cause removal in the transfer restriction agreement.
Yeah, and I would just add, in terms of the management services agreement, one of the things that has to be carefully constructed is, what non-clinical functions are performed by the MSO, what decision-making is reserved to the practice, even if there is a friendly physician involved. Frequently an advisory committee or some collection of existing shareholders would be convened and they would clearly make the clinical decisions. They might also decide about hiring new physicians, credentialing them, setting practice standards. And again, depending upon the leverage of the physician group, more authority can be retained in the practice or in advisory groups like that. But again, the more classic model that we see is where all the non-clinical decision-making is made by the management company, and even the clinical decision-making is ultimately reserved to the friendly physician.
Thanks, guys. And then another typical thing we see with private equity groups that are kind of well developed is this concept of related party ownership, whether those be imaging centers or surgery centers and the like. How do you typically see those treated within a transaction?
Yeah, no, that's particularly in orthopedics, where the ancillaries can be such an important part of profitability. We either see them sold in effect as part of the practice acquisition, and therefore get the EBITDA multiple on that profitability. And that's often where the practice actually owns the ancillaries, be they imaging or lab. But what we now see a lot of in orthopedics is there are surgery centers that have been established either by the physician practice and wholly owned, or sometimes in partnership, either with a hospital or maybe a national management company, where as part of the transaction, there's a separate prong of the transaction where the private equity firm will acquire an ownership interest in the surgery center, but allow the physicians to maintain their own individual or group ownership in the surgery center, and then price that a little differently. But I think in all cases, the private equity firms want their investment to capture all buckets of potential profitability. So it would be unusual to say, why don't you just continue to own this surgery center? We just invest in the practice. I think if they can't get their arms around the profitability through this MSO practice agreement, then the more typical thing would be to request and make a proposal to own a portion, usually a controlling portion of the surgery centers that the group might be owners of.
That's helpful. And just sticking with kind of the legal components of the transaction itself, certain points certainly are going to be more heavily negotiated. Certain points are just more important than others. Could you spend a little time on what are some of the typical kind of either sticking points or heavily negotiated points, and maybe some particular time spent on the employment agreements, which of course are of the utmost importance to physician shareholders as they consider a new partner?
Sure. I think one point that Gardner mentioned was the term of the management agreements. That's something, and what the conditions might be for termination. Is there an ability, if there really are performance problems, to have an ability to terminate that? So that's one area. Another, as you say, Scott, relate to the employment agreements. The management company is nothing if it isn't managing a practice that has engaged, employed physicians. So a key requirement is that all the physicians, or certainly overwhelming percentage, sign employment agreements with the practice that extend for an additional time frame of usually at least 3, sometimes 5 years, and that those employment agreements would reflect compensation terms that have been negotiated. That's really important. What kind of a reduction in what is called normalized compensation is going to be negotiated? Are there incentives for performance on top of that base compensation? That's a second area of negotiation. Restrictive covenants are a very important part of all of these deals. And there are really two varieties of that. One is from the sale of the business. So in connection with actually selling the non-clinical assets to the private equity firm or the management company, there is usually a sale of business restrictive covenant. Typically, we see something in the order of 5 years from the date of the sale where the physician is not able to leave and go work for a competing practice. Now, there's a lot of negotiation around what's the territory, how many miles from the existing practice, is it limited to particular states? In the orthopedic area, is it just an orthopedic practice, or could the physician take a job with a orthopedic device company or a hospital? And those are all points of negotiation. But that one is usually, again, if this investment is going to be made by the private equity firm, they want to know, and frankly, the selling physicians want to know that their partners are really in it for at least a minimum period of time. And usually that is something like 5 years. Then in addition, in the employment agreement, there's a restrictive covenant around non-competing with that practice. That's usually for the term of employment and for a period of usually 1, maybe 2 years after leaving employment. So in other words, after the 5 years expires and you're in year 6 or 7 and the physician decides to leave the practice, these provisions are intended to protect against competing with that enterprise that you just sold your interest in. Again, there's a lot of negotiation around how broad the territory, how long a period of time, what type of competing business is restricted. But that's usually a point of great debate and important that as a selling practice that you negotiate that very, very actively. Then the last piece I would mention, and Gardner, you may have others, is the management fee itself. Is it something that is essentially everything after paying clinical compensation, or are there some adjustments to compensation for performance on the clinical side? But again, most of the time it is a clean sweep of all profits after clinical comp. And the rationale there is this rollover equity. Essentially, the physicians are gaining from that management fee because you are becoming owners of the management company, and therefore the increase in value of the management company will accrete to your benefit as well as the private equity firm.
Thanks, Rick. I'll just mention a few others. The operating agreement for the MSO is often a major point of negotiation. You'll see negotiations around the sort of governance rights that the physicians will have. Generally, they don't have all that much in the way of the ability to control the MSO because they're minority investors, but you will see some minority board seats. Usually the physicians can band together as a group and they'll pick 1 or 2 representatives to serve on the board of the MSO so that they're plugged in and they know everything that's going on up at that level. You'll also see negotiation around sometimes like forfeiture of the rollover equity. Sometimes as a way to keep people from leaving early, you'll have like if you terminate without cause, you forfeit your rollover equity, that kind of thing. Also, there's a lot of negotiation around the indemnity in the purchase agreement. So the buyer is coming in, they're buying a business, they conduct their own due diligence investigation, but they can't possibly know everything that's gone on. There could be all kinds of legacy liabilities. So they want some measure of protection, and it's customary in most M&A deals for the sellers to give some kind of indemnity. So that's a negotiated point. But what we've seen more recently is rep and warranty insurance, where instead of the sellers being on the hook and having to set up a huge escrow account to pay any claims for pre-closing liabilities, they'll buy an insurance policy that will cover breaches of the representations and warranties in the purchase agreement. That generally cuts down on a lot of the negotiation in the purchase agreement, but it comes with its own set of issues because the rep and warranty insurer, they're going to have their own underwriters looking at the business, and they're going to be making sure that the buyer's doing all of its due diligence. It can be a more involved diligence process to get the deal done, and it can prolong the timeline somewhat.
Great, thanks. And we spent a fair amount of time talking about how these deals are structured and how they mechanically get done. But understandably, I assume a bunch of our listeners may be in a position where they're either considering and or planning to go ahead with the process. So trying to understand what they can do to be best prepared in order to do so, I think is an important topic. And so with that in mind, just quickly on the legal front, what would the K&S team advise prospective sellers to think about?
Right. Well, I think that we always advise first that it's really important to get your house in order and to take time, and it doesn't have to be a lot of time, but to be sure that when either the private equity firm or a rep and warranty insurance company are going to look at, are your corporate documents up to date and in good order? Do you have employment agreements with all the physicians? Are they signed? Are you buttoned up with your management team in terms of who's there, who's on board? Have you looked at your referral relationships and reimbursement practices? Is a big compliance exposure, and that is one of the biggest areas that the private equity firms worry about because, as you know, there are potential issues with fraud and abuse. There are issues with recoupment. So it pays to take some time looking at how you're organized and what your arrangements are, and that you've had advice about, that you can withstand a rigorous diligence process. And then really, I'd say secondly, talking among the owner group about what your objectives are so that you're aligned, again, with some practices, depending upon stage of career, interests, et cetera, there'll be, different objectives. To the extent you can really come together and have a common vision. We would like to have a growth capital put into this business. We'd like to have a private equity partner who will help us do M&A and grow, build new ancillary services, add ambulatory care centers. And as part of the process with the private equity firm, they'll pick up pretty quickly if there isn't uniformity. So, are you all singing from the same hymn book? And then also with financial advisors looking at the market and multiples that you're likely to get. Again, depending if you're a platform or an add-on, the multiples will be different, greater for a platform. But at that level of investment, here's what you'll each be taking home. Here's how your compensation will be adjusted. Are you prepared to do that? So that when you meet the private equity firm, you're in a good mode of understanding what's coming, understanding what your key points are, on the employment agreement, the restrictive covenants, are there things that are lines in the sand that are really important? And obviously you also need, with advisors, to understand what the market is, because you can't just get something because you feel it's what you'd like to have. There is a range of options here in the marketplace. And again, getting educated about all of that and being prepared is the first step before you then start to get interest and start meeting with these private equity firms.
Yeah, I think that's a great segue to the next topic, and that is, really a self-assessment of a business and what are the value drivers that you bring to the table. How would that likely play out in a private equity process? Tough to do if it's something you've certainly not been through or simply don't even know what those growth drivers may be. So I'll touch on just a sampling of those. There's a long list of potential topics you could touch on, but I think a few important ones here to touch on are first, the diversification of the EBITDA or the profitability of the business. So investor groups are always looking for this concept of concentration risk. Just as it sounds, any kind of concentration around a certain provider, payer, service line, location could create the perception of risk on a post-close basis. So just to touch on those a bit, from the provider perspective, if it's a business where an outsized portion of the profitability is concentrated within, say, 1, 2, 3 providers, but it is a broader set of care providers in that group, then there's a perception of risk, and that if 1 or 2 of those individuals were to leave, either at the inception of the deal or very shortly post-close, that a lot of that profitability leaves with them. So that's a concept that investors are constantly looking for. On the payer side, there's no right answer per se to this. I would say the average model where we've seen the majority of deals get done, whether it be in orthopedics or other subspecialties, is more typically a commercial heavy mix with a sampling of government payers and the potential for cash pay services offered as well. But again, there's no right or wrong answer per se to that. It's just something to be mindful of. And to the extent that you're heavily concentrated, call it 60, 70, 80% in one of those buckets, just getting your arms around how that could play out in the market, positively or negatively, is something to be mindful of. Service line perspective, we have seen some businesses that on the practice side have some scale to them, have some providers, but maybe, as an example, are dwarfed by the relative size of their surgery center, which may have third-party providers also doing procedures there. That's really not fair to compare to the practice itself, but nonetheless, if you're marketing that ASC alongside, it can look like the weighting's off. So something to be mindful of there. Again, there could be a home for an asset like that, but this concept of concentration, whether it be providers, locations, service lines, something to be mindful of for sure. A centralized back office and just a robust business infrastructure is a real key driver here. So starting with a management team that is really allowing the providers to do their care and not have to pull them into business discussions on a daily basis is very much important. Other aspects that could be invested in by the business, such as HR, billing and revenue cycle management capabilities, marketing, and the like, to the extent that that's been done historically, is done efficiently and proving to be a profitable kind of growth driver, then those are things that are very much viewed favorably by the investment community. An overall track record of growth, so the recruitment and, most importantly, retention of providers, being able to do that on a replicable basis, as well as, and probably a little bit secondarily, but important, to be able to show on an organic basis or even inorganic basis, opening new locations, new service lines, to the extent that you've dabbled into M&A and acquisition, being able to do that on a replicable basis and to digest those acquisitions. These are all things that very much can drive value. And then the last one I'll touch on is a broader set of what I'll call compliance and clinical outcomes. So having the requisite infrastructure from a compliance standpoint that would stand up to the scrutiny of certainly third-party auditors would be important, but also just the due diligence advisors that an investor group would bring in is of the utmost importance. There's certainly risk there should it not stand up to the rigors of an audit type of review. And then clinical outcomes, to the extent that these can be tracked in kind of an evidence-based format and they yield great outcomes, is just great from a marketing perspective, but also really a must-have if you're going to expect to take on investors. And then shifting to the concept of this this compensation reduction for the shareholders, obviously a very important one, and really the basis for the profitability of the business that's used in marketing. So we really see two functions that are used, two methodologies that are used to arrive at what that compensation reduction is. And those are a percentage of collections model, or what we refer to as a scrape model. So in the percentage of collections, this is pretty typical. Many even shareholders in today's businesses actually work under this type of model, whereby you're pegged to a certain percentage of your personal productivity, and it's typically reduced down to an industry norm for your geography, subspecialty, so on, to where you're treated similarly to an employee position, maybe a tick higher than that, just given the fact that you are a shareholder in the business. And it's that incremental, that foregone compensation between what you're compensated today and what that new percentage of collections model yields would be your add back to the profitability. You pool that together amongst all the shareholders. That's where you create, in that scenario, profitability to market to the investment community. The incentive there being, particularly from the investor standpoint, that people are on the perception of really being incentivized to continue to work post-close. It's kind of that eat what you kill model. Same reason why people do it in today's model, even without investors in-house. On the scrape methodology, this is really effective for groups that have a wide disparity of provider comp, which is pretty typical in the ortho space. So there's two ways to look at this. One being a fixed percentage scrape. So the same percentage scraped off of total compensation from every provider. That creates a variable dollar amount that people are contributing. This allows the higher producers to contribute more, which is beneficial because that's where more profitability can be generated to then market to the investor community. And we typically see that scrape percentage of income top out around, call it 40, maybe 45%. Beyond that, the investor community gets a little skittish on just too much being added back. The other side of the scrape methodology would be a fixed dollar scrape. So the variability comes in the form of the percentage compensation added back on a per provider basis. Less effective for groups of wide disparity on compensation because it yields that the highest producers are adding back the same as the lowest producers. Whereas described before, the high producers is really where you're going to be able to generate additional profitability for the business. But it is very effective under that methodology for S corporations that otherwise in a transaction have to distribute the proceeds on an even basis between the shareholders. Using this methodology is reducing comp on an equal basis, and therefore when proceeds are paid out on an equal basis, that's really the fairest way to look at things. So it can be quite useful in that context as well. Now jumping to really the results of a transaction. So we've gone through a process, you've taken on a great partner. How does life change? What does change on a post-close basis? So Jake, why don't we start with you in terms of the ability to recruit and retain physicians and kind of the perception within the employment community from that perspective.
Yeah, of course. So, the ability to recruit physicians after you go through a private equity recapitalization or transaction is, one of the questions we get asked most often by groups who are considering a potential transaction opportunity, and, for really good reason. So recruiting new physicians is, the lifeblood of the practice because, without recruiting, one, there'll be no revenue, but two, in the orthopedic space, what can be even more important to some doctors is, there'll be no one to share the call with. And the last thing that doctors want in a transaction is, going from every sixth or seventh or eighth night on call to having to do it every second or third night. So obviously recruiting has to continue to happen. And, I think a private equity firm can, really assist in this. It can help in obvious ways, such as, increasing the back office resources and systems in place that groups have for recruiting. But, we think the biggest key to recruiting is creating a model where new doctors have a path to equity or profits interest. And I think this is something that maybe not everyone would agree with, but we've seen private equity firms agree that having buy-in and shared incentive from the doctors is extremely important for the continued success of the practice. So as a result, most private equity platforms have mechanisms in place so that new recruits have a path to this partnership. And by partnering with private equity, you can create a type of compensation and a path to equity that you can put in front of these new recruits and very convincingly show them that they will be financially successful and maybe even more financially successful than, than working with a hospital or a traditional independent practice, by coming into that private equity backed platform. So I think that, private equity can serve as a very valuable tool for recruiting on an ongoing basis.
Appreciate it, Jake. And we're running low on time here, so I'm going to give one more topic to the K&S team, and if we can do it in 60 seconds, that'd be fantastic. But really important, so I want to get them in. Typical question we get from physicians is, how does my life change day to day on a post-close basis? And let's extend that even further to the support staff that, particularly in a strategic deal, the perception is that there could be eliminations for those folks. So if you could touch on those topics as a final kind of option here, that'd be terrific.
Sure, do it quickly. Just starting on the non-clinical side, I think it's really important to anticipate what kind of continuity you want as a physician practice. That starts with the CEO of the practice, to the extent that the practice has been successful because there's a great working relationship with the non-clinical leader or leaders. That's important to bring up early on in the negotiation with the private equity firm, and to negotiate an agreement that that individual will stay involved in the practice. Because that has a lot to do with physician satisfaction too, if it's been a successful relationship. Now, some executives, take advantage of this opportunity to depart, but to the extent there's a successful executive team, you can negotiate that up front. You can also, to the extent there are key staff, make arrangements with the private equity firm, indicate why they're valuable, and have commitments that they will be employed by the new MSO. Now, again, where there's a platform in existence, particularly, you have to be realistic about that, and not everyone is going to come aboard the new platform. On the physician side, again, we've seen many of the selling physicians who were in leadership positions, again, negotiate a role in the MSO as clinical leaders. That will allow for continued influence over what happens day to day in your region, or at least to be regional leaders if it's a larger national organization. So those are things to think about, even up at the letter of intent stage, where you're talking about the key terms. Think about what you want in terms of retention and individual positions and leadership roles going forward.
Great, thanks, Rick. And if only we had more time. There's so many topics we could keep going with. I know we cut down our agenda here even for today's discussion. So we really appreciate everyone's attendance here today. I think in summary and in kind of summation here, we're obviously holding this webinar because we view the market as really just kind of heating up. A lot of activity still to come. We know there's a lot of prospective sellers and practices considering the options here. To the extent the Provident team or King and Spalding team can be of any assistance, please do reach out to us. We expect it to be a very active year, and looking forward to hopefully working with some of you all. Rick, Gardner, Jake, thank you for your time today, and thank you for the attendees' time as well. Have a good one.
Thank you.
Thank you.
Thank you.